right, welcome back, everybody, to the Beyond the Deck podcast. I am your host, Beata Rouleau. I'm the founder CEO of Compass Consulting, where we help visionary CEOs scale 1 to 10 million in revenue and convert them from chaotic systems into predictable, scalable revenue. I am super excited to have Melissa here with me. She is the CEO of Lighter Capital, who offers non-dilutive debt financing solutions for SaaS startups. So we live in the same space. Melissa's on the other side. So I'm super excited to learn about what you do. So, Melissa, I'll just kick it over to you to introduce yourself and anything we should know about your journey.
Yeah, well, thanks, Beata, and thanks for having me here. So, as you mentioned, I'm the CEO of Lighter Capital. I was an entrepreneur. I ran two companies that had successful exits, and then I was in venture for the better part of 2 decades. And most recently, I was the managing partner at National Australia Bank's VC arm. So, we funded primarily fintech companies, and one of the companies that NAB funded was Lighter Capital, which is a US based, the pioneer and leader in revenue based financing. And I went on their board in 2018. And then in 2020, I stepped into the CEO role. And Lighter Capital has funded we've done over 1,200 rounds of financing now, primarily to B2B SaaS companies. And it's a non dilutive form of financing. So it's an alternative and oftentimes complementary to dilutive financing from, say, an angel or a VC.
That makes a lot of sense. I actually didn't know that you had two exits. I'm curious, what industry were those in?
The more recent one was software, it was enterprise software. So I founded a software company to automate procurement in Silicon Valley.
Okay, that's amazing. And what was that transition like going from entrepreneur then to the other side of the table to VC? Like how did you flip your brain? I feel like that would be such a different role.
Yeah, it is a really different role. I would say it's a natural progression. A lot of entrepreneurs, when they have exits, they go onto the funding side, whether it's angels or VCs. But I would say one thing I learned when, I had two exits that were both really successful, had great returns for the investors, a 10x and a 15x. So, you think you know a lot when when that happens. And then I became a VC and funded people who are a lot smarter than I am, who worked a lot harder and a lot longer and didn't necessarily have the exits. So you realize how much luck and timing, plays into exits.
Yeah, it's such a good point. And talk me through how revenue-based financing for people that, it makes sense. It's a well-named thing, but talk through like the logistics of how does that actually work?
Yeah. So revenue-based financing is what we say. We fund based on how much revenue a company has. And at Lighter Capital, we can fund up to 50% of a company's ARR. So a company doing 1 million or 3 million in sales could take 1.5 million. If they're smaller, we can fund up to a third of their ARR. But it's a very fast process compared to going for, say, a venture round where it could take months. We're not looking at PowerPoints. There's really nothing subjective in the decision making process. We're taking in the numbers and seeing if it's a fit based on the data. So our application takes 15 minutes to fill out if you're a slow typer. We're looking at your banking data and your accounting data in order to make a decision for funding.
What are the key metrics that you're looking at? Obviously revenue, but what are the other key ones when you're looking at someone's financials? If a entrepreneur is listening that wants this option, what are some things they should be thinking through?
Well, the minimum is 200,000 in revenue and at least 4 customers. So we don't want to see customer concentration. It's difficult to fund something if, say, the majority of the revenue comes from one customer. Low churn and at least a year in business. So those are the minimum criteria. And then there's so much else that we look into. We have spent over $12 million developing our technology. So everything feeds into our underwriting admin tool and we get a risk rating from there. And then that's where the underwriting process begins. But it's pretty quick. I mean, it can be, as little as a couple weeks to funding from application.
Yeah, that's amazing because I work a lot on the VC side and it's not a couple weeks. This is, these
No,
you mentioned the PowerPoints. These are really long drawn out conversations. You're building trust, with the people and the investors. You need to get buy-in, you need to paint the vision, you need to do a lot of things to get to where you know if it's an option or not. So that's great to know that it can happen quickly and then it's really not a big risk in terms of sounds like you could complete the application in 15 minutes and at least know directionally, is this a path that we could pursue?
it's not a big time suck. Like raising VC can take months. Lots of conversations, lots of frog kissing before you might find one who is interested in investing where it's a fit. And we one of the things that we don't look at is team. And when I was a VC, that was really the main thing we looked at. When you ask most VCs, what are they primarily looking at, and they will say it's the founder or the team, which is a very subjective metric.
Right. Yeah, that makes sense. You mentioned 1,200 rounds of financing, businesses that met these criteria. What are some other commonalities or patterns you've noticed with those businesses you've decided to fund versus not? Is there anything else that you've noticed?
Well, we because we've funded so many different companies, we've seen everything. We've seen, the company that's ticking along, growing at 10 to 20% a year every year to, a company. We funded a company, it was called Fishtown Analytics at the time. It's DBA Labs now. We gave them their first 240,000 in funding, and then they've gone on. I think their last round, they were valued at more than $4 billion, and they've raised big venture rounds. So there's every path, but I'd say the most common path is a company that's bootstrapped and maybe has some angel backing. The founder owns most of it. A great company, but probably never going to be a unicorn, but still going to build a valuable company, and they need growth funding. So that would be if I looked at sort of a typical profile of who we fund, that would be a typical profile. Sort of the growth rates of, between maybe 20 and 60%, where VCs are typically looking for something higher than that.
Sense. And how would you suggest for people that aren't in the world of VC and financing, how should someone decide which path makes more sense for their business? Because obviously dilutive for VC, you can get the capital and you can get some great partners in, but you are losing a piece of the pie. So any advice you have for people thinking through which type could make more sense for their business?
You should always, if you have the choice between revenue-based financing and, say, venture financing, and it's apples to apples in terms of size, you should always, always, always take revenue-based financing. And I say that as a venture capitalist. I was a venture capitalist for 20 years. And the only reason that you shouldn't is if that help from the VC is going to be so material that it's worth, the 20 or 30% of your company that you're giving away. We give a lot of help. In fact, I think we give a lot more help than, you know, I did as a VC to our portfolio companies in terms of what's to offer beyond the money. But the reason, and when I'm saying this, let's say you need $1 million and you can get $1 million this way or $1 million in dilutive funding. You should always take it in non-dilutive funding. But typically, a company is going down a VC path because they need a lot more than they could take in revenue-based financing. Like I said before, for smaller companies, we can fund up to a third of their ARR in revenue, and for larger companies, up to 50% of their ARR. So if you think of a company doing $1 million in revenue and wants $5 million in growth funding, we could give them 350,000. They're going to have to be on a VC path.
No, that makes a lot of sense. I do like the revenue-based financing though, because so many companies just get overinflated where you know, having actual revenue, that's the only way you ever get to profit. And so I do like the revenue-based financing because it does force you to actually focus on that versus valuations and multipliers that aren't necessarily based on reality sometimes, and sometimes just based on market trends.
I mean, oftentimes when you're on that VC path, the goal is really the next round? And what do I have to do to get to the next round and have it be a larger valuation than the previous round? And hopefully, what you have to do to accomplish that goal is aligned with what you have to do to build a good company, but sometimes it's more around the story.
I'd love to hear, you mentioned the level of support that you and the team at Lighter Capital provides. What does that actually look like tactically for your portfolio companies?
Well, there are so many ways that we provide support. I would say the way that's the most meaningful when I think about my journey as an entrepreneur is by connecting them with each other. So most of the companies that we fund are B2B SaaS companies. And if one of our entrepreneurs is struggling with an issue or has a question, chances are it has been solved or answered among our portfolio. We do a lot at Lighter to connect the entrepreneurs to each other and help them share from and help them share learnings.
That
Another
is,
thing
yeah,
is a lot of times customers will have shared customers. And to the extent they can do warm introductions to potential customers and pipeline customers, that's really helpful as well.
that's great. Yeah, that makes a lot of sense. A little ecosystem of people, refers, community you can ask questions to. That is very valuable.
Yeah, absolutely. It's what I found the most valuable when I was building a company.
Did you, for both of those exits, where is that from the ground up? Were they venture backed? Did you bootstrap them? What did your team look like? I would love to hear that.
Yeah, well, both were angel backed. So bootstrapped angel backed, not venture backed. And one of the software company, it was fortuitous that we weren't venture backed because as we were just about to go down, we'd been bootstrapped and then had some angel backing. And as we were going down the venture path, we were acquired.
Mm,
And that's where timing comes into play a lot. We ended up in a very hot space and we were ahead on technology. So we had a few acquisition offers, and it wasn't something that we had set out to do, at that time.
right.
We were
Right.
approached.
Which is, I think that's the best way to get acquired when you're just focused on, hey, let's grow year over year. Let's focus on being profitable. And then that's when people want to buy your business, is actually when you're building something that can sustain itself.
Yeah, absolutely. I always say companies are bought and not sold, and in my experience, that's very much been the case in terms of good acquisitions and strong multiples on acquisitions. Oftentimes, it's because it's not that a company was out there trying to get acquired.
Right. Do you have any other advice for founders? We live in a really interesting time in the world of, thinking about software specifically.
Right.
With AI, you can build a lot of software products in an hour with the tools that we have available. And so from my perspective, companies are needing to differentiate in other ways or be able to move really quickly. Do you have any other advice for founder CEOs out there that are in the B2B SaaS space trying to build some new products?
Well, I don't know when this podcast will come out, but this week has been a really interesting one for the space in terms of into public company valuations. But if this comes out in a few weeks, that could have all changed. The advice really hasn't changed. I mean, what we have seen, I would say a year ago, we were more concerned with how AI would affect our portfolio than we are today. And part of the reason for that is we have a shorter term view than a venture capitalist does. Venture capital, they say they have a 10-year horizon. It's really a 15-year horizon. Most funds take 15 years plus to fully exit, where companies are typically working with us on a per transaction basis from 2 to 4 years. So it's a much shorter horizon. So we're really looking at, what could change in the next few years. And AI is certainly changing that. But for the most part, what we're seeing in our portfolio is positive changes in that companies are able to grow more efficiently with the use of AI, and specifically around dev, but also around marketing. So we're seeing companies able to grow without adding materially to their OpEx.
Yes, yes. I think that is the coolest use of AI, is not replacing, everyone's scared of AI replacing jobs. If you're scared of that, then you need to level up your skill set. If AI can replace your job, then you need to go and work on higher level skill sets, because AI should allow us to do more impactful things as humans by getting lower level things off of our plate so we can do what makes us really unique. That is my stance on
Yeah.
it.
Yeah. Look, I mean, the fear is, I mean, I think about the software company that I ran. It was procurement. It was complex. It was for large enterprises, lots of integrations. It'd be a lot easier to build a lot of that with AI. Were our customers going to say, we're just going to build our own procurement solution?
Hmm.
No, not now. So there might be some things that enterprises are taking over themselves versus outsourcing, especially especially I think custom dev is probably is taking a bigger hit. But we haven't seen, at least in our portfolio yet, their customers just saying we're going to do this ourselves. We're going to build this product ourselves.
Right. I'm curious for the companies you're seeing right now, are there specific industries within B2B SaaS that are, the hot markets right now, a lot of businesses in terms of applications that you're seeing for niches within B2B?
Well, what we're looking at, it's a really different lens than what is going to, what's going to be a multi-billion dollar company. We're looking at stickiness of the product. So, and that's a lot of times, sometimes it can be sector specific. We like ed tech because we like gov tech. We like customers where there's not going to be a lot of switch and there's some stability in the customer base. So again, it's a very different lens than venture.
No, it makes a lot of sense. From what you're saying, these are probably harder contracts to get. There's going to be slower sales cycles because of that. These are not companies that are switching, they're not leaving and changing providers every couple of weeks. They're stickier because it's hard to get them because there's so much compliance involved. I would guess that certain areas of fintech could be applicable to that as well.
Yeah, if there's a long implementation cycle, and a long purchasing cycle, the product's less likely to be switched out.
Yeah, it really does feel contrary to how a VC would think about the scale of revenue acquisition. Because for that, you're thinking about what can we acquire quickly? How can we obviously continue to upsell and grow the accounts? But it's not totally focused on long term
Right.
stability of customer base.
Yeah. I mean, of course, VCs heavily focus on churn as well. Every investor does. But I know as a VC, I didn't like companies that had really long sales and implementation cycles. And as a revenue based financing provider, we love that.
Yeah, that's funny. Great. So as we're at the beginning of 2026, anything this year that we should be on the lookout for lighter capital that you want to call out?
Well, one of the things that we are doing it, well, we've built a product called Lighter Analytics, which we offer to our customers, and we also offer to companies that are our customers. If they're B2B SaaS companies, they can put their data in and look at our benchmarking reports and see how they compare to other companies that are their size, in the same size. So say if you're a SaaS company doing $2 million a year in revenue, you can look at things like, how much am I spending as a percentage of my revenue in salaries? How much am I spending in marketing? What's my growth rate compared to others? So we're pretty excited about that. We've always had all this data, and now we're offering it back to our customers.
That's really cool. So for someone that's not your customer, you said they would be able to use that tool as well?
You can go into Lighter Analytics, and you can use the tool for free.
Wow, that is amazing. That would definitely I think I am already thinking of a couple people I'm gonna send that to because that's just helpful
No,
data to
it is
know.
such a great tool.
Yeah. Especially if you are overspending in a certain area, sometimes that could be a wake-up call that people need. "Hey, let's actually look at this
Now, what's
segment on our P&L. What's going on here?" Okay, that's great. And if people want to connect with you or Lighter Capital, give some shout outs for where they could do that.
Yeah, lightercapital.com. It's Lightr capital.com, and connect with me on LinkedIn. It's Melissa Widner, Widner, and I'm always happy to talk to entrepreneurs.
So, Melissa, thank you so much for your time. I think this is going to be really helpful to the CEO founders and my audience. So, really appreciate the time.